If you are an investor in Singapore T-bills, or if you were hoping to park your cash in a safe six-month fixed deposit, you probably saw the number this week and felt a cold shiver down your spine. 1.39%. That was the cut-off yield for the latest 6-month Singapore T-bill. Just a few months ago, we were effortlessly collecting 3.8%, 3.9%, sometimes even crossing that magical 4% mark. But now, we have crashed through the floor to 1.39%. That is a massive drop in income for retirees and conservative savers. It effectively means the easy money era is dead. But here is the headline that is confusing everyone. At the exact same time that yields crashed, the Straits Times index, the STI, smashed a record high of 4,124. If yields are crashing, why is the market rallying? Most people are misreading this. They think the market is just bubbling up. But if you strip away the noise, what we are seeing is not a bubble. It is a great rotation. The market is aggressively pricing in a growth-first environment for 2026. The smart money has already realized that sitting in cash at 1.39% is a guaranteed way to lose money against inflation. So, capital is fleeing those safe havens and flooding into assets that offer a spread. This isn't a fluke, it is a fundamental shift in how we need to manage our Singapore portfolios. Hi everyone, I'm Iggy, your Singapore-based market analyst. And my job is to cut through the noise, ignore the sensationalist headlines, and show you what really matters for your CPF, SRS, and SGX portfolios. And we have been putting in the work to make sure you stay ahead. Since October 2025, this channel has produced over 1,200 videos with more than 600,000 watch hours. We were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls before the mainstream news picks them up. Today, we are going to do exactly that with a deep dive, slide by slide, through the winners and losers of this new rotation. We are going to look at why the easy 4% is dead and exactly where that money is going. First, let's set the scene with the macro data. The market didn't just go up, it went up specifically in sectors that rely on trade flows and leverage. We are seeing a divergence. The safety trade, which is your T-bills and fixed deposits, is fading. The yield plus growth trade is waking up. Let's move to our first case study, and this is the one everyone is talking about. Frasers Logistics and Commercial Trust, or FLCT. If you just looked at the headline numbers, you might have panicked. FLCT reported a distribution per unit, or DPU, drop of 12.5%. For a dividend investor, a double-digit drop usually screams sell. But the stock rallied 4.8% this week. Why? Let's break this down methodically. First, let's look at the revenue. Revenue was actually up 5.6% for FY25. The engine is working. The DPU dropped solely because of higher finance costs. Essentially, the interest payments on their debt went up, eating into the distributable income. But the market is a forward-looking machine. Investors are looking at two specific metrics that tell a very bullish story. Metric number one is rental reversion. FLCT reported a positive rental reversion of 39.6% for their logistics portfolio. Now, what does positive rental reversion actually mean for you as a unit holder? It means that as old leases expire, the new tenants are signing on the dotted line, paying almost 40% more than the previous guy. That is immense pricing power. It proves that despite the economic gloom, demand for logistics warehouses is scorching hot. Metric number two is occupancy. They are sitting at 99.7% occupancy. They are effectively full. Now, here is Iggy's perspective on this. This is the classic look forward, not backward trade. Retail investors saw the DPU drop and got scared. Institutional investors saw the 39.6% reversion and the 98.7% occupancy. They know that as interest rates fall in 2026, FLCT's finance costs will stabilize. When those costs stabilize, that massive rental growth will flow straight to the bottom line, resulting in a DPU spike in the future. Furthermore, look at their aggregate leverage. It is sitting at 35.7%. For a REIT, this is incredibly healthy. In an environment where many REITs are struggling with leverage near 40% or 42%, FLCT has a massive debt headroom. This means they can go out and acquire distressed assets while their competitors are stuck trying to pay down debt. This is my highest conviction pick for the rotation trade. FLCT is trading at roughly 1.1 times price to book with a 6.5% yield. Compare that 6.5% to the 1.39% you get on a T-bill. It's a steal. I am buying the logistics story and I am willing to tolerate the slight weakness in their commercial portfolio because the math simply works. Next, let's look at the conglomerates. Jardine Matheson, J36, and Jardine Cycle and Carriage, C07. The Jardine complex has been what we call dead money for about 3 years. It just hasn't moved. But suddenly we saw a 5.6% move this week. What changed? For Jardine Matheson, J36, they announced a US $250 million share buyback. When a company buys back its own shares, it reduces the supply of shares in the market, which theoretically increases the value of the remaining shares. It also signals that management believes their own stock is undervalued. This sets a hard floor on the price. However, let's look at Jardine Cycle and Carriage, JCC. Their revenue held steady, up 1%, despite a 23% drop in net profit, which was mostly due to non-cash items. Here is Iggy's perspective. While J36 is the safe haven, I prefer JCC. Why? Because JCC is effectively an ETF for the Indonesian consumer. Through their ownership of Astra, they dominate the Indonesian automotive market. We are seeing a global trend where funds are returning to emerging Asia. And as the US dollar weakens, emerging market assets tend to outperform. I want exposure to the Indonesian electric vehicle and motorcycle transition. And Astra is the kingmaker there. If you want a 5% yield with a growth kicker, JCC is the better play over the parent company. Now let's move to a local favorite, Keppel Limited, ticker BN4. Keppel has been on a tear. 9-month net profit is up over 5%, but the key number here is recurring income, which is up 15%. For those new to Keppel, you need to understand the narrative shift. Keppel is no longer just a rig builder. They are transforming into an asset manager, very similar to Blackstone. They are executing an asset-light strategy. This means they are monetizing all heavy assets, selling off M1, selling off legacy rigs, and recycling that cash into high growth areas like data centers and infrastructure management. The market loves this because asset management commands a higher valuation multiple than rig building. As long as that recurring income growth stays in the double digits, the stock price is supported. However, here is Iggy's assessment. Keppel at 10.24 is getting expensive. The easy money has been made. I am holding my position because the company is quality, but I am not adding new money here. The 3.7% gain this week feels a lot like FOMO, fear of missing out. Valuation matters. I would wait for a pullback to around 950 before deploying fresh capital. Don't chase it at the top. So we've covered the winners, but in every rotation, there are stocks that get left behind. This is where the real alpha or excess return can be found if you know where to look. We call these the laggards. Are they value traps or are they deep value opportunities? First up, UOL Group, U14. UOL was down 0.6% this week, consolidating after a run. But let's look at the valuation. UOL is trading at a price to NAV net asset value of roughly 0.5 times. Let me translate that into plain English. For every 50 cents you invest in UOL stock, you are buying $100 worth of tangible assets. We are talking about prime hotels, shopping malls, and land banks in Singapore. Their first half net profit surged 58%. This wasn't just driven by selling condos at Pine Tree Hill or Watton House. It was driven by a massive recovery in their hotel operations, Pan Pacific and Park Royal. Tourism is back and UOL is cashing in. So why is the stock lagging? The market is pricing UOL as if the Singapore property market is about to crash due to cooling measures. Here is Iggy's perspective. I call this the fear discount. See, the market hates property developers right now. But UOL isn't just a developer, it is a major landlord and hotelier. The balance sheet is a fortress. Analysts peg their true value, their revalued net asset value, nears $14.60. The stock is trading below $800. That is a massive margin of safety. I am aggressively buying this weakness. You are essentially getting their entire hotel portfolio for free at these prices. This is the 50-cent dollar trade. Finally, let's look at a laggard that I am much less optimistic about. Lendlease Global Commercial REIT, JU. Lendlease was down 1.6% this week. Why is it lagging while Frasers Logistics is rallying? It comes down to two words, Milan and GEM. Lendlease recently divested the office component of GEM to lower their debt. That was a responsible move, but it created an immediate income vacuum. Their DPU dropped about 6.9% because that rental income is gone. But the bigger problem is in Europe. They are restructuring the lease for their Sky complex in Milan. Sky Italia returned Building 3, which creates a vacancy. Now, Lendlease has to find a new tenant in a tough European market. That is execution risk. The metric that matters here is the yield spread versus a blue chip peer like CapitaLand Integrated Commercial Trust, CICT. Lendlease is forecasting a yield of about 6.0% to 6.3%. CICT is yielding about 4.7% to 5.2%. The spread or the extra income you get for taking the risk with Lendlease is only about 1.3%. My view is simple. Is a 1.3% extra yield enough compensation for the headache of releasing an empty office building in Italy? No. In a risk-on rotation, money flows to the cleanest story first. FLCT has 99.7% occupancy. Lendlease has a vacancy problem in Europe. Until Lendlease proves it has filled the Milan vacancy, it is dead money. I would only be interested if the yield spread widened to over 2% against CICT. For now, avoid it. So let's bring this all together in our conclusion. What are the new rules of engagement? The easy 4% era is officially over. The collapse of the T-bill yield to 1.39% has removed the safety net for Singaporean investors. We are entering a market phase that punishes passivity. You cannot just sit in cash anymore. What is working? The boring growth trade. Logistics. REITs like FLCT and conglomerates like Jardine are seeing capital inflows because their cash flows are visible and their yields exceed 5%. What is not working? The safety trap. Cash and T-bills are now guaranteed to lose purchasing power against core inflation. And pure office plays with execution risk, like Lendlease, are being punished. My final recommendation is split into two parts. For your aggressive portion, rotate those maturing T-bills into Frasers Logistics, FLCT, or even Maple Tree Logistics, MLT. You want to lock in that roughly 6% yield before the unit prices rise further and compress that yield. The window is closing. For your conservative portion, accumulate UOL Group on dips below $800. You are buying a fortress balance sheet at 50 cents on the dollar. It requires patience, but it will eventually re-rate when interest rates settle. The market has moved. Make sure you move with it. If you found this analysis valuable and want to go even deeper into the specific entry prices and portfolio allocation strategies, consider becoming a free or paid subscriber to the Investing Iguana Substack. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 19 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.